Hi, everyone. Welcome to Conversations with Curio. This is a place where we get curious about all things investments and financial planning related, and just try to have really good conversations. My name is Jim Kantowski. I'm a co-founder of Curio Wealth in Annapolis, Maryland. I'm joined by my partner and co-founder, Jake Sadler, who's in Asheville, North Carolina, and we are extremely grateful to have with us today from Dimensional Fund Advisors, Karen Umland, who is the Senior Investment Director there at Dimensional. Karen, did I get that correct?
Yeah, that's my title.
Okay. And you're on the investment committee?
Yes, for many years at Dimensional.
Yeah, long time.
Yeah.
So this is really great because Karen's going to be way smarter than Jake and I, and we're going to just ask her some questions, and she's going to fill in the gaps. So, Karen, thank you so much for joining us. I'm going to try and set this conversation up a little bit. We're going to talk today about indexing, and indexing has become extremely popular throughout the years. It's gotten some great press. It's done a lot of really good things for sort of the investment world and the average investor. It's brought costs down really low, and it's given opportunities to individuals to invest in a pretty simple and easy way. And so we're going to talk about the benefits of indexing, but there also may be some better ways to do things. And you guys there at Dimensional Funds are always sort of ahead of the game and doing great things. And so we'll talk about some of maybe the downsides or things you need to think about when you're indexing, and also some things, maybe how to look at it a little bit differently. Does that sound all right to you?
Yeah, that sounds fantastic. And I think in many ways, Dimensional's in kind of a unique position to talk about this particular topic, because as you may be familiar with, the founders of Dimensional were actually involved in some of their earliest index funds. So, kind of back before the founding of Dimensional, for example, involved in index funds like early versions of the S&P 500. But I think what we've seen is that a lot of things have changed since then. Certainly, as you've alluded to, indexes have become way more popular. There are many, many of them out there. In fact, I've heard estimates to greater than 3 million different variations of indexes. The other thing that's happened is Dimensional, although we have our roots and we have some kind of things in common with indexes, low turnover, diversification, that we've actually kind of evolved in a different direction, particularly in the way that we go about portfolio management, trading, which you might consider the implementation of our ideas into portfolios. So, I think it's kind of interesting to think about some of the similarities and some of the contrast there.
That is awesome. So, Jake, I know you wanted to start out with the question of just sort of defining what an index actually is, because some of the people on here just may not know exactly what that is. So maybe we could just start there, and then we'll just have a conversation and just ask different questions as we move forward.
Yeah, that sounds fantastic. So yeah, when you think about index funds, it's kind of in a way a pretty unique investment vehicle, in the sense that there's an index or a benchmark. And the index itself, when you think about the portfolio, many of the decisions that go into what that portfolio looks like are actually made by index providers. And by index providers, we mean the Russells of the world, the MSCIs of the world, are the ones that really decide some important aspects in terms of what stocks are included. If we're talking about international markets, what countries are you including? What are you classifying as developed versus emerging? And then a really crucial one that I'm sure we'll have a chance to get into in more detail is how and how often do you rebalance to make sure that you're maintaining that index? So all that's decided by the index provider. And then we're all very well familiar with index fund managers. Index fund managers are essentially the fiduciary, the investment manager who's hired. And typically, though, their main objective is to track that index fund. And oftentimes what we see is the main thing that they're measured against is actually that tracking. Are they perfectly mimicking the index fund? Which is kind of an interesting relationship in terms of the different parties involved in creating an index and how it goes about actually being managed day to day.
Hey, Karen, what is an index? Like,
So getting sure,
like,
like getting to the heart of the question.
yeah, like what is it?
The relationship? It's a group of stocks at certain weights that represents a certain market. So getting to the simpler part of the answer, many investors are really investing in those index funds because they want broad market exposure, and that's what the index delivers. It represents either a market, think about, US market broadly defined, or some segment of the market that is certain stocks are set at certain weights. And that's meant to be something that you can track and then get basically the delivery of that particular asset class. The other thing that indexes are used for is benchmarks. So actually, I think originally when you look at the purpose of indexes, part of the purpose was measurement. So, measuring active managers that aren't tracking the benchmark versus, something that's achievable to get exposure to that same asset class and seeing whether that active manager is actually delivering outperformance over time.
So were they set up to be actual investments, or were they just set up as an idea to be able to track performance? Do you know the answer to that question?
Yeah, I think that in a sense, probably more of the latter. I think the original idea of a benchmark was really something that would allow investors to really measure that performance and track that asset class. But it's been many decades now where they've also been, of course, translated into investment vehicles.
Yeah. So what happens, Jake, and you could maybe chime in here, is like us as sort of portfolio managers or investment advisors sort of get compared to these indexes. And, so we'll have clients come to us, or we'll have prospects or whatever. They'll say, hey, how have you done against the index? And that's sort of the benchmark, as you described, that we're trying to beat or compare ourselves to make sure that we're doing what we should be doing.
Yeah, absolutely. Absolutely. But index providers who create those benchmarks are also well aware that part of what they're getting used for is the benchmark, as you described, but they're also well aware that there are many index funds that are tracking their benchmarks. And it's an interesting balance because those are both things that they need to take in consideration in terms of their purpose, how they structure the index, how often they rebalance it.
So
Karen, go ahead, Jake.
Yeah, I just kind of want to stick on the idea of the index providers deciding what goes in the index, defining what goes into the index. What are some of the pros and cons of the index provider being in that role of deciding what's in this basket? How do we define this market segment?
Yeah, so interesting question, Jake. There are pros and there are cons, I think, of the index provider being in that position. I think one of the pros, and probably one of the things that index providers would point to in their own role, is they're meant to be a third-party objective definition of a market. So there is that kind of distance in some way in terms of being an objective decision maker about how you could think about defining a market. But I think one of the cons is that, if you're an investor and you are managing, or you're assessing your performance, I should say, by whether your index fund manager is actually tracking that benchmark, who's kind of assessing the decisions that the index provider is making? Because those decisions, of course, translate into returns. Decisions about stocks, about countries, about weights, when you add stocks. The timing aspect can be often overlooked, but really, really important. And, again, the one that we talk about a lot, which is how are you maintaining that benchmark to make sure that you don't have style drift? I mean, your purpose is to define a market. You want to make sure you continue to define the market. As we all know, markets are dynamic, and it takes some reconstitutions or rebalancing to adhere to that original purpose. So I'd say, to kind of shorten the answer a little bit, there's that sort of third party where the entire business is to figure out how to define the market. But then there's kind of this fiduciary question, kind of who's the fiduciary here? Is it the index fund manager? And if it is, who's actually evaluating the index provider themselves?
Mm-hmm. So you kind of have this. Oh, we got tons of questions.
Yeah. We do. I was just going to say, like, I was struggling a little bit. So there's this manager who's implementing a portfolio as an index, and then there's the sort of the group that's designing the index. Like, it sounds like there's just a ton of different variations. So like, there's an index set up by somebody, and maybe you can describe who that is, and then there's a manager trying to sort of follow that index.
Yeah, no, absolutely. And so there are a lot of different index providers. As I mentioned, there are lots and lots of indexes out there. But if you were to pick a simple one, for example, you could think about the S&P 500, one of the best known indexes that is out there, replicating, of course, or designed to replicate the U.S. large cap market. And so it would be S&P who would be deciding, for example, what those constituents of the S&P 500 are. The index fund manager is making sure that they then adhere to those stocks in that weight. And then importantly, if a stock gets added, a stock gets removed, that they do that as well so that they continue to mimic the benchmark. And, I find the S&P 500 a really interesting one in the sense that it seems pretty straightforward. You're looking at U.S. large cap stocks, one of the biggest, most liquid group of stocks that there is. Many investors think that the S&P 500 is the largest 500 stocks, just kind of simply put. But in fact, it isn't. It's decided which 500 stocks those are by committee. So there's a committee that determines which stocks are in the S&P 500. And then importantly, when does a stock get big enough that you add it? When does it meet all of the criteria of the S&P 500 to add it? And if you have a moment, I could provide an example that could be of interest, which is one of Tesla. So there's, a company that's well known. The S&P 500 added Tesla in late 2020. By the time they added it, it was already a very large company in the U.S. market. In fact, if you look at the beginning of 2020, it was easily high, I think maybe 60th or something like that. So well within the top 500 stocks, but not yet added to the S&P until very late that year, toward the end of 2020, because there were other types of criteria that S&P looks at before they added that stock. And in the case of adding Tesla, that resulted in missing a lot of appreciation of Tesla in that year. I think it went from number 60 to something like in the top 10. And really can cause performance differences versus, say, a benchmark that had, over that period of time, a company like Tesla. So, it's not an isolated example. We have other examples of companies that by the time they come into the S&P 500 have long been within, easily those top 500, if not even kind of a larger group, because there are additional criteria that S&P is looking at. They might look at things like earnings, whether there's been positive earnings over a certain period of time, for example. So I think the point is not to say, okay, this is bad. They shouldn't be looking at these additional criteria. I think the question is, how many people are aware of it? Is it transparent? What are those reasons that go into adding stocks at a certain time versus not? Who's the fiduciary here, and then who is evaluating that fiduciary? So I think one of the takeaways from all that is that if you're investing in an index fund, you want to do a little bit of due diligence and have some awareness of what's actually happening at the index provider level who's making all of those decisions. And they can sometimes feel a little bit more, subjective, I guess you could say, than what you might otherwise have assumed of that particular benchmark.
Karen, it's really, I'm hearing you say kind of, the index providers, their role in defining what's in the index, deciding what's in the index, has this impact on the end investor.
Yeah.
May not always be apparent. And you mentioned earlier, and for DFA, kind of DFA has this, background and these roots in indexing.
Yeah.
But has evolved.
Right.
So as we kind of think about, okay, indexing, if you're an end investor, there may be some kind of hidden pros and cons, but challenges to being an index fund investor. I mean, how has DFA evolved beyond indexing to address some of these issues that you're pointing out with the index provider deciding and defining what's in the index, the timing of, when companies are going in and out of the index? How is DFA responding to those challenges?
So, and Karen, before that, just as part of that question, it sounds to me like what you also described is like you can have an index and then different providers can implement that in different ways. You can have different variations of it. Is that a correct understanding? There's flexibility.
Yeah. So I think if you look at what you might consider to be really traditional indexing, typically, if you have a benchmark like an S&P 500, and then you have index funds that track that benchmark, those index funds will look the same. Essentially they will. There can be some different processes around buying and selling stocks that are adding and deleted. But there's limited flexibility if you really want to track that benchmark. So typically speaking, if you're defining yourself by tracking a benchmark, you want to look as close to it as possible. Otherwise, you incur tracking error. So for example, when a stock is added to an index, if an indexer adds that stock at exactly the same price as the underlying benchmark that they're following, they'll have zero tracking. So, that tracking error goal is something that kind of limits your flexibility around kind of when to trade it, how much to trade, and which stock to trade. And, to answer Jake's question, I think one of the things I'd probably go right to is this concept of flexibility. So dimensional also, one of the purposes of our portfolios is to give that broad market exposure. So if you look at something like a dimensional total market portfolio, one of our core portfolios, we're providing dedicated comprehensive exposure to that total market. Or a small cap fund will give diversified exposure to small cap stocks. And there's a whole different angle about using research to try to kind of tilt toward outperformance. But I think the contrast that I want to make here is more about the implementation. So when we're designing the market, we don't design it to necessarily match a particular benchmark. We have our own definition. We've got our own database of what constitutes a diversified group of stocks and what that looks like. But also, importantly, we have to maintain our portfolios as well. As I mentioned before, markets are really dynamic. Maybe a simple example is that one of a small cap portfolio I talked about earlier. If you see stocks move from small to large, eventually you're going to want to remove them or sell them from that small cap portfolio. Same thing from a stock moving from large to small, or value to growth in a value portfolio. So you have rebalancing to do. Dimensional's approach to doing that is to incrementally rebalance through the days of the year using flexibility. And we like that word, flexibility, because we think it has a lot of benefits. One is that it allows us to really focus on keeping trading costs low. And that's probably really where the thinking about all of this started at Dimensional. Because on a given day, if we're broadly defining the market, there's a group of different stocks that we could potentially buy or sell to kind of maintain that portfolio the way that I described. And we want to give our traders some flexibility so that they can really use that flexibility to think about keeping trading costs as low as possible. Because one of the big pillars of Dimensional is we know that trading costs can take a big bite out of returns if you're not careful. And we want to keep those as low as possible, particularly for parts of the market like small cap, like certain countries that are less liquid where trading costs can potentially be really high. Something that matters everywhere, but matters, particularly in areas where you could really lose a lot of return if you're not careful. And we think that flexibility helps a lot. We've tested that. We've worked on it over the years. We've done a lot of analysis of our own trading costs that gives us some confidence that we think is the right approach to rebalancing and maintaining portfolios. So very different from kind of an index adds a stock or deletes a stock to match that benchmark. And all of that tends to happen right around the index reconstitution date. So in kind of a very big contrast in terms of our day-to-day portfolio management, same goal, we want to make sure we deliver the market, but a different approach. And then one more thing, I know I've talked a lot, this is a subject that's very at the heart of what Dimensional believes in. But the other thing that we're big believers of is not allowing style drift to the extent possible in our portfolios. If we have, back to that small cap example, a small cap portfolio, when small cap, the size premium is positive, we don't want to be on the sidelines. We want to make sure we've kept that portfolio small cap. And that's another reason why we think that incremental rebalancing through the days of the year is something very important rather than, for example, rebalancing once a year, a couple times a year, and then just letting those stocks stay in the index in between those periods of time, regardless of what their characteristics become. So a few different concepts there, but, very different approach at Dimensional.
It definitely sounds like a different approach compared to you think about flexibility versus, I don't know, a rigid approach, but, an index defined approach. you mentioned style drift a couple of times.
Yeah.
DFA, really doesn't want to deviate, doesn't want to have the style drift. If indexes have style drift, why is that happening? What are the reasons contributing to that?
Yeah, so style drift. Again, this idea that, say, for example, you construct a small cap portfolio, you hold it over, say, like a Russell index rebalances once a year, you hold it over the course of the year. Some of those stocks might become large and no longer fit the definition of the market. And depending on how often you rebalance, there's a greater possibility to have more style drift if you rebalance infrequently. So why would you think about that? Well, kind of gets back to this theme of there are a couple of different objectives that the index provider who makes the decision of the frequency of rebalancing, the Russells, the MSCI, the S&P, have to think about. And one is they do want to manage the style drift. They want to make sure that their index stays what it's intended to stay, but they have to be cognizant of things like costs and turnover for the indexers who are tracking their benchmark when they rebalance. Because as I mentioned before, those costs, when you're doing concentrated turnover all at one time can potentially be high. One of the reasons for that is, you think about a group of stocks maybe being added or removed from a benchmark. The whole market sees it coming because it's, kind of predetermined. Everybody knows the date that's going to happen. So if you have limited flexibility to have to buy a stock when it's being added in the company with all the other index fund managers who have to buy that stock, there's just a potential for that to be costly. We tend to see volumes of those stocks being at many multiples at that period of time than where they typically trade. And there's just the potential of having a lot of market impact, potentially moving prices of those stocks if you're really trading a lot more than's typically traded. And, kind of trading in the same direction, the same stock as a lot of other funds when the market sees it coming can potentially be really costly.
Is that trading cost you're talking about, is that the same or incorporated into the expense ratio, or are they two separate costs?
Those are entirely two separate costs. And so the reason that managing trading costs is so important is because trading costs will eat away at your returns. And ultimately, what we're looking to deliver to investors in our funds is returns. So you will not necessarily see it if, for example, say an index fund adds a stock during a reconstitution period of time, and they happen to buy that stock at the high price of the day. So, for example, and they would, if the index adds it at the same price, they perfectly track it. But there's a trading cost, there's market impact in there. There's, paying a higher price than maybe you would have otherwise paid if you were able to kind of spread out that trading over a longer period of time, for example. So those trading costs, if you think about buying at that high price, that's going to be something that affects your return, but absolutely doesn't necessarily show up in expense ratios.
So when we think and we hear about like these extremely low costs on these index funds, that's what shows up in the expense ratio, but there's other costs that may reduce the returns of those funds, which is a cost, like losing or having lower returns is essentially a cost.
Yeah, no, we would completely agree. And, we sometimes think about more of a holistic framework to consider costs. And certainly that holistic framework would include expense ratio. That's something that investors, of course, want to look at. But it also includes trading costs, both commissions that you pay, but also the sorts of costs I was talking about before are usually characterized as implicit costs. So those can potentially be higher than things like expense ratios and commissions if you're not careful, particularly in less liquid parts of the market. There's also, the more kind of theoretical idea, which can be harder to measure, of opportunity cost. But opportunity cost is important. Our belief is that there are premiums in the market. You can pursue this equity premium itself. You're looking to achieve that when you invest in stocks. Dimensional also seeks premiums around things like smaller cap stocks, value stocks, and higher profitability. But we know that those premiums have volatility to them. They can happen at unpredictable times in large amounts. So if we're looking to capture those premiums, an opportunity cost would be allowing drift in our portfolio so we don't fully capture them during the periods of time when they're positive, because those can be really important. As I mentioned, they can happen quickly, unpredictably, and you can get a lot of return in short periods of time. So we want to make sure that we're positioned to capture those premiums when they are positive in market. So that holistic framework, in addition to trading costs, also takes in consideration things like opportunity costs of managing funds. And there's a whole bunch of other things that we can think about in the day-to-day management of portfolios that can add up incrementally in returns, the way we decide on things like corporate action, decisions around dividends and tenders and mergers in our funds. We do lend securities and get revenue from securities lending. How much of that we return to the fund, how good a job we do of getting the revenues while having proper risk controls in place. All of those things should be considered, we think, when you think about a holistic framework of the types of costs, both explicit and opportunity costs, that ultimately, again, affect your returns, because that's what we're in the business of doing, is delivering returns.
And let me just make one comment, Jake, and I know you probably have a question. So thinking about that, like if you have an index and then you have a way of managing a portfolio that has some flexibility to work around the index and do some other things like security lending and look at things holistically, in theory, that should outperform or give you the opportunity at least to outperform the index without like having to take into consideration like timing and making changes based on like the market environment. Is that, I'm not asking like you to compare the dimensional funds or anything like that, but in theory, that's what you're looking to do, is create outperformance through taking a holistic approach.
Yeah, no, that's absolutely correct. At the end of the day, all of these elements are designed to look to outperform in the portfolios, to add value in the portfolios, from the way that we structure the portfolios to how we use flexibility in day-to-day management, to all of the elements that I talked about. And dimensional, we don't want to leave return on the table. So we're thinking about both incremental returns as well as kind of, this concept of these returns that we capture in markets. But all this is designed to outperform. You can think about outperformance as your portfolio structure, the returns you're looking to capture, the research we're incorporated, potentially minus all these things that can detract from returns. And every one of those pieces of the framework are things that we want to make our best efforts to, either improve those returns or reduce those costs to eventually lead to outperformance.
Karen, you talking about improving return, reducing cost, focusing on like implicit and explicit costs. What about taxes? I mean, when we think about, tax efficiency, we're also thinking about improving return and kind of reducing total lifetime cost in a tax sense. What's DFA doing to kind of create tax efficiency, within your portfolios?
Yeah.
Say compared to an index fund approach.
Yeah. So, in tax efficiency, obviously such an important element to so many of our investors out there. So tax efficiency is definitely something that we think about in our portfolios. And when you think about the contrast to an index fund, I think, look, as a starting point, both the dimensional funds and index funds are, generally speaking, pretty well diversified, less turnover than, say, high turnover active funds. So right from the get-go, that will help in terms of just the amount you need to trade in your portfolios in order to keep them the way that they're intended to be positioned. So right off the bat, those things put you in a better position for tax efficiency, low turnover, broad diversification. But I would come back to this whole concept of flexibility again when we think about tax efficiency, because if we're incrementally rebalancing and we have choices of candidates that we can buy and sell in order to maintain our portfolios, and we're doing that over time, another layer that we can take into consideration is tax efficiency. If we have choices between a security that would incur a gain versus one that wouldn't, we can actually have different options in our portfolio. That's something we can take into consideration. As soon as you start constraining your flexibility really in any way, you just have less degrees of freedom to overlay these other considerations, and tax efficiency is certainly one of those.
Be really intentional. It's kind of what I'm hearing, in terms of it's this balancing act between flexibility and control. So just being intentional. Yeah,
absolutely.
Jake, do you have other questions? We've kept Karen on here for quite a while. I was just going to ask, like, if there's any other things that we should be considering with indexing. We've talked a lot about the cost. We've talked about style drift. We've talked about taxes a little bit. What else, what we might consider in terms of when we're comparing, an index to another approach that we might have, or something we need to consider? Karen.
Question for me.
Yeah.
I think we actually, really covered a lot of ground in the conversation. And I guess I would, think about maybe some thoughts to kind of sum up what I was talking about before. And if I were to go very high level, thinking about index funds, I would say, this concept that many investors choose index funds to kind of tick the box for broad market exposure. And I think what's really interesting there is just this idea that there's no one way to actually define that broad market exposure. One of the things we didn't really get into is that it's really interesting if you line up the returns year to year of different index funds across different providers, say on the small cap side, an S&P versus Russell versus a CRSP index, that you can get really disparate returns. So you can have big swings. I think when we looked at returns of, say, 3 major small cap providers year by year, on average in any given year, the difference was something close to 5%, which is typically what you might think about, active versus a benchmark, rather than benchmarks that are essentially just have different methodologies in a given year. So these things really matter. And so it kind of calls into question, does it make sense to incur costs, the sort of costs that we talked about, to perfectly track something that by its definition is not really perfect to begin with? There's no one perfect solution, versus, define the market broadly, bring into play your research, but take everything that to kind of keep those costs low in the way that you manage and you rebalance. So I think that whole concept is really at the heart of some of the examples I was giving earlier, and also kind of at the heart of the reason that Dimensional has kind of evolved in this somewhat different direction in the way that we actually manage and trade portfolios.
Yeah, that's awesome. So I think that's what I was trying to get to earlier in the conversation, is like, you might pick one index, but another one might perform differently. There's different options. So you need to be really thoughtful or intentional, as Jake mentioned, about, which index you're actually choosing. They're all not built the same way.
Yeah, absolutely.
Yeah.
I really like that comment, Karen. So trying to track something perfectly that isn't perfect to begin with.
Absolutely.
It kind of summarizes at least my thoughts from this conversation on index approach.
Yeah. Karen, thank you so much for having this conversation with us and your willingness to talk to us. We are always so grateful for our relationship we have with Dimensional Funds. It's the expertise and the things you guys are doing is amazing. So just thank you so much for the opportunity to speak with you today.
Yeah, absolutely. And thank you for the opportunity to join.
All right. Have a great day. Thank you so much.
Thanks.
Thanks, Karen.
Bye.